All right, let's jump into this, shall we? We've got a big one today. Auditing. You know, when you sent these excerpts over, and wow, these look intense, like something straight out of a CPA exam prep course.
Mm,
I have to admit, I thought, oof, this is going to be dry. But the more I look at this stuff, the more I realize just how much auditing impacts, well, everything.
it's true. Auditing often gets this reputation for being all about numbers and rules, but it's really more like, detective work. You're piecing together evidence, trying to figure out if a company's financial statements are telling the whole story, and more importantly, a truthful one.
So it's more than just making sure the math adds up.
Oh yeah, way more.
Hmm.
It's about getting to the bottom of things, making sure the numbers are reliable, and that they paint an accurate picture of the company's financial health.
Okay, so let's break it down. The source keeps talking about this idea of demystifying auditing. It says an audit isn't just about checking for errors, it's about obtaining evidence to support an opinion on the financial statements. What kind of opinion are we talking about here?
Good question. It's not just a simple yes or no, good or bad. Auditors issue different types of audit opinions. The best case scenario is an unmodified or unqualified opinion. Basically, it tells the world, hey, these financial statements look pretty fair and reliable.
So if I'm thinking about investing in a company, an unqualified opinion is what I'd want to see. It's like a seal of approval, right?
Exactly. It gives you a level of confidence that the numbers can be trusted.
Makes sense. But what happens when an auditor doesn't give an unqualified opinion?
Well, there are a few other possibilities. A qualified opinion, for instance, means the auditor found something that doesn't quite line up with accounting principles, but it might not be a deal breaker.
So it's like a yellow flag, not a red flag.
Yeah, kinda. The source gives an example of a qualified opinion because of inadequate disclosure. Say a company isn't totally transparent about how they calculate depreciation or deferred income taxes, that could raise eyebrows.
So even a seemingly small detail, like how depreciation is handled, could impact the art opinion and ultimately an investor's decision. That's a lot of power. And this whole idea of trust brings us to our next point. Auditor independence. Why is it so important for an auditor to be independent from the company they're auditing? I mean, wouldn't it be easier if they were all buddy-buddy?
You might think so, but think of it like this. Would you trust a doctor who also owns stock in the pharmaceutical company that made your medication?
Probably not. I'd always wonder if they were recommending that specific medication just to boost their own profits.
Exactly. The same principle applies to auditing. The auditor needs to be totally independent to make sure their opinion is unbiased and objective.
Mm.
Otherwise, well, the whole audit loses its value.
Right, because even a hint of a conflict of interest could completely undermine the purpose of the audit. And I can't help but think of the Enron scandal. Didn't that whole mess highlight what can happen when auditor independence is compromised?
Absolutely. It was a textbook case of how a lack of independence can lead to disaster, not just for the company, but for investors and the market as a whole.
Yeah, not good. So we've established that auditor independence is super important. But how do you actually ensure that in the real world? Are there specific rules in place?
There are, definitely, and we can dive into those a bit later. But first, let's switch gears and talk about internal control. Now, I'll admit, when I first heard about internal control, I imagined dusty old rule books and endless procedures, like something out of a Dickens novel. But it's actually much more than that, isn't it?
It sounds like it.
Yeah.
So internal control, it's like a company's internal security system, protecting their assets and making sure their financial reporting is accurate.
Precisely. It's like a network of checks and balances designed to safeguard the company's resources and make sure everything is running smoothly. And it goes beyond just preventing fraud.
So it's not just about stopping bad things from happening. It's also about making sure everything's running efficiently.
Absolutely. Think of it this way. Strong internal controls help a company operate more effectively and efficiently, which ultimately benefits everyone.
Okay, I see. Now, the source mentions something called the SINOSO framework. It sounds pretty technical, but I'm guessing it's related to internal control. Can you give us a quick breakdown?
Sure, the COSO framework is a way to think about and structure internal controls. It outlines 5 key components, but let's focus on one that's especially important: segregation of duties.
Segregation of duties. That sounds like it involves dividing tasks among different people. What's the point of that? Wouldn't it be easier for one person to handle everything?
Easier, maybe, but definitely not safer. Imagine if the same person was responsible for, say, ordering office supplies, receiving the shipments, and authorizing the payments. It'd be incredibly easy for that person to create fake invoices, receive imaginary goods, and pocket the money.
Oh, I get it. So separating those duties adds a layer of accountability, like checks and balances within the system, making it much harder for someone to slip in a fraudulent transaction.
You got it. It's a simple concept with a big impact. By making sure no single person controls an entire process, you drastically reduce the risk of errors, intentional or not.
This is really interesting. It's like you said, internal control. It's more than just boring rules and regulations. It's about protecting a company's assets, ensuring accurate financial reporting, and making sure everything runs smoothly. But what happens when things go wrong? That's where the detective work of auditing comes in, right?
You got it. This is where things get really interesting. Auditors use a whole range of procedures and techniques to gather evidence and piece together the financial puzzle.
Okay, so let's put on our detective hats and dive into those procedures. The source mentions inquiries, inspections, confirmations. It sounds like they've got a whole arsenal of tools at their disposal.
They do. And one of the most fundamental techniques is something called directional testing.
Directional testing. That sounds intriguing. What is that?
Well, imagine you're trying to trace the origin of a rumor. You might start with the person who told you and ask where they heard it from, working your way back to the source. That's kind of like vouching. Auditors start with an entry in the accounting records and work backwards to the original source documents. They're making sure there's a solid paper trail, a real transaction behind every number.
So they're making sure the numbers on the books are backed up by real-world evidence. What about tracing? Is that going in the other direction?
You got it. Tracing is like following a package from its starting point to its destination. Auditors start with source documents like invoices or purchase orders, and then they trace them forward to make sure they're accurately reflected in the company's accounting records.
Okay, so vouching is going backwards to validate the records, and tracing is moving forward to make sure everything's captured correctly. It's all about connecting the dots, making sure the information flows smoothly from source to final record.
Exactly. And it's all about building that audit trail, making sure there's solid evidence to support every number.
Got it. Now, the source also mentioned something called a walkthrough. What's that all about?
Walkthrough is exactly what it sounds like. Auditors actually walk through a transaction from beginning to end, observing how the company's processes work in real life. They're not just checking boxes on a checklist. They're actually seeing how things happen on the ground.
Wow, that's pretty hands-on. So it's not just about crunching numbers, it's about understanding how the business actually operates.
Exactly. It's about getting a feel for the company's culture, their control environment, and how they manage risk. It gives auditors a much deeper understanding of how the company functions and helps them identify any potential weaknesses.
Okay, this is making a lot more sense now. We've got different types of audit opinions, the crucial importance of auditor independence, the role of internal control, and these key procedures auditors use to gather evidence. But how do auditors actually decide where to focus their attention? Do they just randomly start digging through records, or is there a more strategic approach?
That's where risk assessment comes in. Auditors don't just randomly choose what to examine. They spend a lot of time identifying and assessing risks.
Risks of what exactly?
Risks of material misstatement. Basically, those are errors or potentially even fraud that could significantly distort the financial statements.
So they're looking for the areas where things are most likely to go wrong, where someone might be tempted to fudge the numbers.
You got it. And certain areas are naturally more prone to manipulation. Accounting estimates, for example, like the allowance for doubtful accounts or pension liabilities. They involve a lot of judgment and assumptions, so they're potential targets for a misstatement.
Wait, can you remind me what those are again? Allowance for doubtful accounts.
Sure. That's like setting aside money for customers who might not pay their bills. And pension liabilities represent the company's future obligations to its employees' retirement plans. They're complex calculations that can be manipulated if someone wants to make the financials look rosier than they actually are.
Okay, so those are definitely areas where auditors would want to dig a little deeper, just in case. Any other red flags they look out for?
Definitely. Related party transactions always require extra scrutiny.
Related party transactions, that sounds a bit shady.
Well, they can be. It's basically when a company does business with its own executives, directors, or their family members, there's a higher risk of conflicts of interest there.
Right, because if the CEO's brother-in-law is getting a sweetheart deal from the company, that's not exactly an arm's-length transaction.
Exactly. Auditors need to make sure those deals are on fair terms and not designed to benefit those insiders.
Okay, so auditors need to be on the lookout for any signs of favoritism or special treatment. And it sounds like they need to have a good understanding of human nature, too. After all, they're dealing with people who might be tempted to bend the rules.
You're absolutely right. Auditors need to be part accountant, part detective, and part psychologist.
Absolutely. Now, before we move on, there's one more concept I'm curious about, going concern. Why is it so important for auditors to figure out whether a company's going to stay in business? Isn't that more of a CEO's problem?
You'd think so, but it has major implications for the financial statements. If a company's on the verge of bankruptcy, its assets might not be worth what they're stated at, and their debts might not be collectible.
Ah, so those shiny financial statements could be built on a foundation of sand if the company's about to go under.
Exactly, and that's where going concern comes in. Auditors need to determine if the company is likely to survive for at least the next year. If there's serious doubt, it needs to be disclosed in the financial statements.
So it's like a warning signal to investors.
Exactly. It's basically saying, hey, there are serious concerns about this company's future.
Okay, that makes sense. But what are some of the red flags that make auditors question a company's ability to stay in business?
Well, financial difficulties are a big one. Things like defaulting on loans, consistently negative cash flows, trouble getting new loans.
So those are pretty clear signs that a company might be in trouble.
Yeah, but it's not always about the numbers. Things like labor strikes, legal problems, losing a major customer, or even relying too heavily on a single product or project can all be indicators that a company's future is uncertain.
So it's like a financial checkup for the whole company. Auditors are looking for any signs of illness, anything that might threaten its long-term survival.
That's a great way to put it. It's about looking beyond the numbers, understanding the bigger picture, and making sure the financial statements tell a true and fair story.
This is fascinating. I'm starting to see financial statements in a whole new light. There's so much more beneath the surface than I ever realized. But wow, we've covered a lot of ground. I think we've earned a little break.
I agree. Let's take a breather and come back to dive even deeper into the world of auditing.
Okay, so before the break, we were talking about auditors basically playing the role of financial fortune teller, trying to figure out if a company is going to stay afloat. Talk about pressure.
Right. And that just highlights how their role goes way beyond just crunching numbers.
Absolutely. And this next section really drives that point home. It says that auditing standards, they actually go beyond GAAP, those generally accepted accounting principles that kind of dictate how companies report their financials.
Yeah, it's like there's a whole other layer of standards that apply specifically to the auditors themselves.
So there are rules for the referees as well as for the players. Makes sense. Got to keep everything fair and square. But what kind of standards are we talking about for auditors? Is it just about being good at math?
Oh, it's way more than that.
Yeah.
These standards address things like, well, we talked about auditor independence earlier. That's a big one. But also the quality of their work, how they communicate with, the higher-ups, the audit committee and all that, and of course their ethical responsibilities.
Ugh, ethics. Yeah, that's a big one. It's not enough to just know the rules, right? Auditors have to have a strong moral compass, too. It's kind of like those detective shows where you've got the brilliant but flawed detective who's willing to bend the rules to catch the bad guy. You definitely wouldn't want that in an auditor.
Exactly. And the source even specifically mentions the AICPA Code of Professional Conduct. It's like a set of ethical guidelines that auditors are supposed to follow. Things like integrity, objectivity, confidentiality, those are non-negotiables in the auditing world.
So it's not just about finding the right answer. It's about doing it the right way. Honesty, integrity, all that good stuff. Okay, that makes sense. But auditing can't be all rules and ethics, right? There's got to be some room for creativity and judgment. After all, no two audits are exactly alike.
Oh, absolutely. And the source actually makes a point of emphasizing the importance of professional judgment in auditing. It's not just blindly following a checklist. Auditors have to weigh different factors, consider different perspectives, and make decisions based on the specific circumstances of each audit.
So it's more of an art than a science.
You could say that. It takes experience, expertise, and a healthy dose of skepticism.
Skepticism, like they shouldn't just take everything at face value.
Exactly. They need to question everything, look for inconsistencies, and not just take management's word for it.
So they're kind of like investigators, always on the lookout for anything that seems out of place.
You got it. Okay, but let's get down to the nitty-gritty here. How do auditors actually gather the evidence they need to make those judgments? We talked about some procedures like vouching and tracing, but what else is in their toolkit?
Yeah, tell us more about their detective work.
Well, they've got a whole arsenal of techniques at their disposal. In addition to, vouching and tracing, they do things like inquiries, inspections, confirmations, analytical procedures. All these are designed to obtain what they call sufficient appropriate evidence to support their conclusions.
Hold on. Sufficient appropriate evidence. That sounds so formal and legalistic.
I know, right?
Yeah.
But it basically means that the evidence needs to be, well, sufficient, meaning enough of it to be convincing. But it also needs to be appropriate, relevant to the specific claim they're making.
So they can't just cherry pick the evidence that supports their preconceived notions.
Exactly. They need to consider all the evidence, even if it contradicts their initial assumptions.
Okay, I'm starting to get it. So what are some specific examples of these procedures?
Well, one common procedure is examination or inspection. This involves actually looking at things, like tangible assets, or examining documents and records to verify that they're accurate and authentic.
So for inventory, it's not enough to just look at a spreadsheet. They might actually go to a warehouse and count boxes, make sure what's on the computer matches what's physically there.
Exactly. It can get pretty hands-on. And for documents, they'll look at things like invoices, purchase orders, contracts, anything that backs up the numbers on the financial statements.
Wow, so they're really digging into the details. What about confirmations? You mentioned those earlier.
Confirmations are a great tool. It's like getting independent verification directly from the source. So auditors might send confirmations to banks to verify account balances or to customers to confirm outstanding receivables.
So they're basically double-checking the company's records with outside sources.
Exactly. It helps to ensure that the information is accurate and reliable.
Okay, that makes sense. What about analytical procedures? Those sound kind of mysterious.
They can be. It basically involves comparing financial information to expectations, looking for anything that seems unusual. It's a bit like those detective shows where they're analyzing patterns and anomalies to, track down the culprit.
Can you give me an example?
Sure. Let's say an auditor is looking at a company's sales data. They might compare this year's sales to last year's sales, or they might compare the company's sales trends to industry averages.
And if something looks fishy, they dig deeper.
You got it. It's all about connecting the dots, looking for those subtle clues that something might not be right. Now, let's talk about something that might surprise you. Sampling. Auditors rarely examine every single transaction. Instead, they use sampling techniques to select a representative portion of the data.
That makes sense. If you're dealing with a huge company with millions of transactions, it would be impossible to look at everything. But how do they make sure the sample they choose is actually representative?
There are different statistical methods they use, like random sampling. The goal is to get a reliable picture of the company's overall financial health without having to examine every single transaction.
So it's like taking a blood sample to assess your overall health. You don't need to drain your entire body of blood to get a diagnosis, right?
Exactly. Now, speaking of getting a better picture of a company's financial health, let's talk about something that's really changing the game in auditing. Audit data analytics.
Audit data analytics. That sounds like something out of a sci-fi movie. Is this where artificial intelligence comes in?
It does. It's about using technology to analyze massive amounts of data quickly and efficiently. Imagine being able to scan through millions of transactions in seconds, looking for those little red flags that might indicate fraud or error.
Wow, that's incredible. It's like having a super-powered magnifying glass that can zoom in on the tiniest details.
Exactly. And one of the most exciting things about audit data analytics is the ability to analyze 100% of the data, not just a sample. This gives auditors a much more comprehensive view of the company's operations.
But wait, does this mean that human auditors are going to be replaced by robots?
Not quite. It's more about a partnership between human expertise and technology. The technology can do the heavy lifting of data analysis, but it still takes a skilled auditor to interpret the results, use their judgment and figure out what's really important.
So auditors of the future, they'll need to be as comfortable with coding as they are with accounting principles.
It's definitely heading that way. Okay, so now let's get into some specifics. Let's dive into a specific area of the audit, like the expenditure cycle.
The expenditure cycle? That sounds like it has something to do with spending money.
It does. It's basically all about how companies purchase goods and services and how auditors make sure those transactions are recorded accurately.
So we're talking about everything a company needs to operate. Raw materials, office supplies, equipment, that kind of stuff.
Exactly. Each of those purchases represents a transaction that needs to be documented, authorized, and recorded properly.
So auditors are making sure that every dollar spent is accounted for and that the company isn't just, writing blank checks for things they don't actually need.
Exactly. And one of the key things auditors look for is You guessed it, segregation of duties.
Ah, there it is again. You don't want the same person ordering stuff, receiving it, and then paying for it, right?
You got it. Separating those duties is crucial to preventing fraud and errors.
Okay, so segregation of duties is a big one. What other procedures do auditors use to make sure everything's on the up and up in the expenditure cycle?
Well, they might vouch a sample of entries, in the accounts payable listing, back to the original invoices and purchase orders, just making sure there's that paper trail, that everything's legitimate.
So it's like following the money, making sure it all leads back to a real transaction.
Precisely. They also use confirmations here, just like we talked about earlier. They might confirm accounts payable with vendors,
Yeah.
sending a request to the supplier to verify the amounts owed.
So double checking with the other side of the transaction to make sure everything matches up.
Exactly. It's a great way to catch any discrepancies or hidden liabilities.
I'm seeing a pattern here. It's all about gathering evidence from multiple sources, cross-checking information, and looking for anything that seems fishy.
That's exactly what it is. And that same meticulous approach applies to other areas of the audit as well. Let's move on to the cash cycle, which is arguably one of the most important areas for auditors to focus on. Why do you think that is?
Well, cash is king, right? It's the lifeblood of any business. And it's probably the easiest to steal.
You nailed it. Cash is so susceptible to fraud. That's why auditors are super focused on it. One of the key procedures they use is the bank reconciliation.
Bank reconciliation, that sounds familiar. Isn't that something I'm supposed to be doing with my own checking account?
You should be. It's basically comparing your records of cash transactions with what the bank says. It helps catch errors and discrepancies.
Okay, so for a company, auditors are comparing the company's records to the bank's records, making sure everything lines up.
Exactly. It's a way to make sure that all the deposits and withdrawals are accounted for and that there's no funny business going on.
Funny business, like what?
Well, there are all sorts of schemes people use to manipulate cash. One example is something called kiting.
Kiting? That sounds like a fun way to spend a day at the beach.
Not this kind of kiting. It's a way to inflate your cash balance by shifting money between different bank accounts at just the right time. It's like a shell game with money.
Wow, people are sneaky.
They can be. But auditors have ways to catch these tricks, like using a bank cutoff statement, which helps verify that all those deposits and checks actually cleared the bank. Okay, so now let's talk about another area that's ripe for misstatement: the inventory cycle. Inventory is often a company's largest asset, which means any errors or misstatements there can have a huge impact on the financial statements.
Right, so auditors need to be extra careful when it comes to inventory.
They do. And one of the most exciting parts of auditing inventory is that it often involves getting out of the office and going to the client's warehouse to observe their inventory count.
So auditors might find themselves trekking through warehouses, climbing over boxes, maybe even getting a forklift certification.
It's definitely one of the more hands-on parts of the audit. It allows auditors to actually see the inventory, verify its existence and condition.
It sounds like an adventure. But what happens if the company has inventory stored in multiple locations, like in different warehouses?
Good question. If the inventory is held off-site, like in a public warehouse, auditors might observe the count there or get confirmations from the third-party custodian. It's all about making sure that the inventory is actually there and that it belongs to the client.
This is all incredibly fascinating. I never realized how much detective work goes into an audit. We haven't even talked about investments, payroll, or all those complex financial instruments that companies use.
We've only scratched the surface. Auditing is a vast and complex field, and there's always more to learn.
I'm ready to keep exploring, but I think we've earned another break. We'll be back to continue our deep dive into the world of auditing after a short break.
We're back, and I'm still thinking about those auditors, out there in the warehouses, maybe even operating a forklift to check inventory. Talk about getting your hands dirty.
It definitely highlights how auditing is a blend of meticulous analysis and real-world investigation. Totally. And speaking of investigations, this next section focuses on the investment cycle. Now, this is where we get into the world of stocks, bonds, maybe even those complex derivatives everyone's always talking about. I have a feeling this area can be pretty tricky for auditors to navigate. What do you think?
Oh, absolutely. The investment cycle, it can be a real headache, especially with all the different types of investments companies are using these days. But the good news is that those core principles of auditing, they still apply. We're still talking about gathering that reliable evidence to back up the numbers on the financial statements.
So whether it's a simple stock purchase or some crazy complicated derivative strategy, Auditors are still looking for that paper trail, that independent verification.
Exactly. The procedures might change depending on what kind of investment we're looking at. Like for those straightforward investments, like publicly traded stocks and bonds, confirmations from the custodian holding those assets can be really effective.
So it's like verifying that your, I don't know, your valuable jewelry is safe in a bank vault. You get that confirmation from the bank that it's actually there.
Exactly. But when you start talking about those more complex investments like derivatives or investments in private companies, well, things get a lot more challenging.
I can imagine. So what do auditors do in those cases?
Well, they really have to roll up their sleeves and understand those valuation models that are being used, really assess the underlying data and assumptions, and sometimes they even bring in specialists, like valuation experts, the big guns.
So sometimes they need to call in for backup to make sure they're getting the full picture.
You got it. It's not just about confirming that the investments exist. It's about making sure they're being reported at their fair value. And that can be a moving target, especially depending on what's happening in the markets.
Sounds like auditors need a pretty deep understanding of finance and economics on top of their accounting knowledge.
Yeah, it's not just about crunching numbers. You really need to understand the bigger picture. Okay, now let's shift gears a bit and talk about an area that, well, let's be honest, can be a bit shady sometimes.
Yeah.
Related party transactions.
Oh, yes. It's like those family business reality shows where all the drama unfolds. But what makes these transactions so risky from an auditing perspective?
Well, because related party transactions, they involve dealings between a company and, well, its own executives, directors, or even their family members, there's a built-in risk of conflicts of interest. It's hard to know if the company is getting a fair deal.
Right, like if the CEO's nephew suddenly gets a super favorable loan from the company, that's not exactly an objective business decision, is it?
Not really. And that's why auditors really scrutinize these kinds of transactions. Look for those red flags.
Red flags like what?
Oh, things like maybe the pricing seems unusual, or the loan terms are way too generous, or the whole deal just doesn't make business sense.
So basically, auditors need to approach related party transactions with a healthy dose of skepticism.
Exactly. Trust but verify, as they say. And that cautious approach, it applies to litigation as well.
Litigation? Oh, you mean lawsuits?
Yeah. Anytime a company is involved in a lawsuit, auditors have to figure out how it might affect the company financially, potential losses, legal fees, all that.
That makes sense, but how can you determine the financial impact of something that hasn't even been decided yet?
It's tricky, for sure. They work closely with the company's lawyers, looking at all the legal documents, trying to estimate the likelihood of different outcomes.
So they have to think like lawyers as well as accountants.
Pretty much. It's about giving investors a clear picture of the company's situation, even if there's some uncertainty hanging over their heads.
This whole conversation really highlights how auditing is all about presenting a balanced and accurate picture. It's not about sugarcoating things or hiding problems. It's about transparency and giving investors reliable information.
Exactly. Okay, so remember we talked about going concern. Auditors basically trying to assess if a company will survive.
Oh, yeah, that was a good one.
Well, the source actually provides this really helpful list of red flags that auditors look for, things that might suggest a company's in trouble.
Like what?
Oh, recurring losses, negative cash flows, problems with debt, those are the obvious ones. But also internal issues like strikes or losing a major customer, those can be just as damaging.
Right, because even if the financials look okay right now, if there are underlying problems that could threaten the company's future, that's something investors need to know.
Absolutely. And this whole discussion about going concern really ties back to the importance of professional judgment in auditing. It's not just about following a checklist. It's about looking at all the evidence, considering the bigger picture, and making those tough calls.
Speaking of judgment, let's talk about misstatements for a minute.
Misstatements. Oh, that sounds bad.
Yeah.
Are we talking about every little typo or rounding error?
No, not those. Auditors are really focused on what they call material misstatements. These are errors that could actually influence someone's decisions, if they're relying on the financial statements. So it's about those errors that really matter, the ones that could mislead investors.
Exactly. And figuring out if a misstatement is material is more of an art than a science. It depends on a lot of factors, the size of the error, the nature of the error, the potential impact on users of the financial statements.
So a $10,000 error might be a big deal for a small business, but just a drop in the bucket for a huge corporation.
Precisely. Context is everything. And if auditors find a material misstatement, they'll work with management to get it corrected. But ultimately, it's management's responsibility to decide whether or not to adjust the financial statements.
Okay, so management is in the driver's seat, but the auditors are there to make sure they're staying on the right track.
Exactly. It's all about collaboration and making sure the financial statements are accurate and reliable. Now, before we wrap up, I want to touch on one last piece of evidence auditors gather: the management representation letter.
Management representation letter. That sounds important.
It is. Basically, it's a letter from management where they acknowledge their responsibility for the financial statements. They confirm they've given the auditor all the information and access they need, and that they believe the financial statements are accurate and complete.
So it's like a signed confession.
Well, not exactly a confession, but more like a formal acknowledgement of their responsibilities.
Okay, so we've covered a lot of ground in this deep dive. We've talked about the core principles of auditing, the procedures auditors use, the role of technology, the importance of independence and judgment. It's been really eye-opening.
It has, and we've really only scratched the surface. Auditing is a constantly evolving field, but hopefully this deep dive has given you a better understanding of what auditors do and why their role is so important.
It definitely has. Now, I know I'll never look at a financial statement the same way again. It's amazing to think about all the work that goes on behind the scenes to make sure those numbers are reliable.
So the next time you see an audit report or hear about a financial scandal, remember this deep dive and all the work that auditors do to protect investors and the public interest.
And remember, keep asking questions, challenge assumptions, and never stop learning. That's what the deep dive is all about.
Well said. Until next time.